Bad credit is probably the number one thing stopping people from buying a home. That or maybe down payment. But I've already addressed that you don't need a ton of money when it comes to buying a home. That's why I'm setting the record straight that you don't need great credit to buy a home. You want to buy your first home, but maybe you don't have 20% to put down or perfect credit. That's okay. If you're committed to a home purchase, then I'm here to help you do just that, maybe even sooner than you thought possible. My name is Scott Wynn, and I am a licensed mortgage advisor with the Wynn and Egan team at Citywide Home Loans. If you want to buy a home in the next 12 months, then click that subscribe button, and together we'll make it happen. Most people are led to believe that in order to buy a home, you need great credit. But what is great credit anyway? Well, many people think that great credit is anything over 780. Well, I'm here to tell you right here and right now that that's simply not the case. You do not need a 780 credit score in order to buy a home. But before I explain what it really takes to buy a home when it comes to credit, let's talk about how credit scores work. The first thing you should know is that you don't just have one credit score. In fact, there's a credit score for just about every type of loan you might get. Whether it's an auto loan, yep, there's a score for that. A credit card, a different score for that. And a mortgage, a different score for that. And in fact, you have your own consumer score as well. So when you use those credit monitoring services, either through like Credit Karma or your credit card, the score that you're receiving is a consumer score, not the score that the mortgage company will see when they pull your credit. And from my experience, a consumer score is generally a little bit higher than what you'll see when the mortgage company runs your credit report. That brings me to another point. The point about the range of credit scores. What's the minimum score that's out there? What's the maximum score that's out there? Well, it's not as straightforward as you might think. See, each credit bureau has different score ranges. Some as low as maybe 250, some as high as 900, but generally the range is somewhere between 300 and 850 for a credit score. The one thing that most credit bureaus do agree upon is the rough formula to calculate those scores. Now, their formulas are not always exactly the same, but they all fall within this particular structure. 35% of your credit score is based on your payment history, the payments that you make or don't make on your debts. 30% is based off of the amounts owed in comparison to the limit. 15% of your score is based off of the length of your credit history. How long have your accounts been open? 10% is based off of the mix of your credit, such as mortgages, auto loans, student loans, credit cards, things like that. And the last 10% is based off of new credit. And if all of this wasn't confusing enough, here's another problem, is that some creditors choose to only report to one or two credit bureaus instead of all three. So one creditor may report only to Equifax, while another might report to Equifax, Experian, and TransUnion. All of that causes your scores to be different with each credit bureau, which we'll get to here in a moment. So let's get this straight. So there's multiple credit scoring models with multiple credit bureaus, all using slightly different formulas to calculate your score, where some creditors may only report to one bureau. Frustrating, right? Well, ultimately, in the end, it all seems to even out. In my experience as a mortgage advisor running literally thousands and thousands of credit reports, there's not one particular credit bureau that's always the lowest or the highest. And that's exactly why mortgage companies, when they pull your credit, pull all three credit bureaus. And then what they use is the middle of your three scores. With all of that said, I was a little curious about what is the average credit score these days? Well, according to Experian, the average credit score right now in the United States is 704. Now that's the average consumer score, so not necessarily the mortgage score. But what does that 704 score mean? Is that good credit? Is that great credit? Well, according to Experian, here's how they bucket the credit scores. A credit score between 300 and 579, according to Experian, is considered very poor. 580 to 660 is considered fair. 670 to 739 is considered good. 740 to 799 is very good. And 800 or above is considered exceptional. So the average credit score of a 704 would be considered a good score, according to Experian. But who really cares what Experian thinks? What we're concerned about is, what do mortgage companies think? So let's talk about mortgage qualifying when it comes to credit. So each loan program has different rules or requirements when it comes to credit scores. Well, FHA is probably the most lenient loan program when it comes to credit. And FHA has a minimum credit score of just 500. Now, before you get too excited about that 500 credit score minimum, one thing you should realize is that with a 500 credit score on FHA, you're required to put at least 10% down. To avoid a 10% down payment using FHA, you have to have a credit score of at least 580. But there are credit requirements too, not just the score. Things like foreclosures, bankruptcies, collections, and things like that. There are certain time requirements that have to be met. So for example, with a foreclosure, at least 3 years have to pass. For a Chapter 7 bankruptcy, at least 2 years. And for collection accounts, you can't have more than an outstanding balance of $2,000. But even if you meet the minimum score requirements and the credit requirements, there's this thing called layered risk. Basically, the more negative items you have on your credit, the more layers of risk there are to the lender that you might default. See, the only thing that the mortgage lender has to go on in terms of whether or not they think you're going to repay in the future is based on whether you've repaid in the past. Now, whether or not that's the best way to go about doing it, who knows? But that's the only thing they have to go off of, and so that's what they use. So to mitigate this layered risk, what lenders do is they put in place additional rules on top of the loan program requirements. These additional rules are referred to as overlays. And credit score is one of the most common overlays we see with mortgage lenders. So even though FHA requires a minimum 580 credit score for their minimum 3.5% down payment loan program, many lenders will add additional overlays requiring, let's say, a score of 600 or 620. So what do you need to buy a house and to get qualified for a mortgage? Well, you certainly don't need great credit or even very good credit according to Experian in their range that they've provided. You just need fair credit, which is a credit score of 580 or above. There are certainly benefits of having higher credit scores in terms of possibly the interest rate you might get, or the loan program you might qualify for, or the mortgage insurance, which means you might want to know how to boost your credit quickly, right? Well, here's my suggestion. Don't do it on your own. Work with a mortgage advisor who can look at your credit from the perspective of qualifying for a mortgage and not just focusing on getting you a higher credit score like many credit repair companies do. Here's why. There are many situations where increasing your credit score can actually have a negative impact on your ability to qualify for a mortgage. One example of this is disputing accounts on your credit report. Disputing accounts on your credit report are a common strategy used by credit repair companies in order to get negative items to drop off of your credit report. But the problem is when it comes to mortgage qualifying, disputed accounts can cause an issue in underwriting. Paying off collection accounts is another example. See, when you pay off a collection account, what happens is you pay off an old account to a zero balance, which basically awakens that account up with recent activity. So now you have a negative item with recent activity. Now granted, the recent activity was paying that down to zero, which sounds like it would be a good thing for your credit, but actually can have a short-term negative impact and therefore can impact your ability to qualify for a mortgage. Those are just two simple examples out of many that I could share with you. Why I think working with a mortgage advisor and the tools that they have to help you in boosting your credit, like our Credit Booster program, can help you even more so than you trying to do it on your own. And normally, there's no cost associated with that. Their goal, of course, is to help you with your mortgage to get qualified so that you can buy a home. So there you have it. You don't need great credit to buy a home.
Did I answer the question you came looking for? If not, leave your question in the comments below and I'll be sure to reply. And if you found the info helpful, I'd love a click on that like button. If you're serious about making your first home purchase, check out these other videos as you work towards buying a home. Or you can call or text me and I can help you directly.